The live trading price for Lithium Americas Corp. LAC is currently $5.64, showing a drop of $0.10 or negative 1.83% in today's intraday session. This is a subtle but telling move, reflecting a market that is constantly reevaluating the narrative around North American lithium supply. The immediate expectation, the one you hear most often when talking about a stock like this, is a direct linear correlation with the general electric vehicle or EV demand story. The logic is simple. More Tesla stock sales, more Apple stock chatter about their EV program, more NVIDIA stock powering the autonomous tech means more demand for batteries, which means more demand for Lithium Americas product. However, the reality, the unappreciated insight that's driving the current intraday choppiness and the slight dip isn't about demand at all. It's about the price of the commodity itself, specifically lithium carbonate and hydroxide prices, which have seen significant pressure in global markets, and the persistent execution risk baked into a massive, multi-billion-dollar domestic mining project. That's the curiosity loop we need to unpack. Why is a stock tied to an essential future commodity struggling when the demand for the end product seems so robust? It forces us to look past the surface-level optimism and examine the ground-level complexities of resource development, financing, and geopolitical strategy that truly influence the ticker. The common ground understanding is that Lithium Americas is positioned to be a cornerstone of the domestic lithium supply chain in the United States, primarily through its Thacker Pass project in Nevada, which is often touted as the largest known lithium resource in North America. This perception has led to surges in the past, often on news of regulatory progress or funding milestones. This is the bullish expectation, a pure play on American energy independence backed by government interest and major players like General Motors. But the contrarian take, the deeper reality, is that this stock isn't trading on future production capacity yet, it's trading on the cost of capital and time. The recent announcement that Lithium Americas received its first drawdown of $435 million from the US Department of Energy's Advanced Technology Vehicles Manufacturing, or ATVM loan program for Thacker Pass, was a major catalyst, and it did provide a temporary lift. Yet look at the trading volume and the daily swing, the stock struggles to hold those gains. Why? Because securing the funding is only one piece of a colossal capital expenditure puzzle. The market knows that execution risk in large-scale mining projects is historically high, and the sheer scale of the Thacker Pass endeavor means delays and overruns are always a specter. For an investor choosing between the relative stability of a diversified portfolio through Fidelity, or the algorithmic precision of Schwab Intelligent Portfolios, or even the simplicity of an individual brokerage account with SoFi Invest, a mining stock like LAC represents an entirely different risk profile, one where the reward is delayed by years of construction and operational ramp-up. The sheer timeline of getting from a resource to a revenue-generating operation is what puts downward pressure on the stock during periods of broader market uncertainty. It becomes less about the lithium market's future and more about the company's balance sheet today. The current price action is a perfect reflection of this tension. Enthusiasm for the long-term strategic asset is battling the short-term reality of a non-revenue-generating entity burning cash on construction. Zooming in on recent stock movement, the daily swings for Lithium Americas Corp have been highly volatile, far outpacing the standard market indexes. Over the last month, the stock has traded on heavy volume, particularly around major news events. For example, the aforementioned DOE loan drawdown news caused an immediate significant jump, but the follow-through was weak. This suggests a pattern of buy the rumor, sell the news trading, where fast money capitalizes on headlines, but longer-term institutional buyers are holding back, waiting for concrete, verifiable progress that de-risks the construction timeline. Trading volumes have remained elevated, sometimes seeing 20 to 40 million shares trade hands in a day, which is massive for a company of this market capitalization. This elevated volume is characteristic of both high-conviction buying and systematic de-risking by larger institutions, which is important to remember if you're managing your own self-investing portfolio. On the institutional activity front, recent 13F filings indicate a mixed bag, which further muddies the waters. While some institutions are clearly increasing their positions, viewing the current low valuation as a buying opportunity on a strategic U.S. asset, others are decreasing or even completely liquidating their positions, possibly reacting to the softening lithium commodity prices or simply rotating capital into less construction-intensive assets. The trading volume and price action signal that retail investors are often caught in the middle of this institutional churn. This is where an educated investor, utilizing a platform like Interactive Brokers' trading platform for sophisticated order types, or even a more consumer-focused interface like the Robinhood stock trading app, needs to understand the underlying mechanics. The stock's recent dip coincides with a general cooling in the lithium market, where prices for battery-grade materials have fallen from their historic highs. This macro pressure in the commodity sector is a significant headwind, completely independent of Lithium Americas' operational progress. Sector momentum in materials has also lagged some of the more exciting high-growth tech sectors, where you see stocks like Nvidia stock driving the narrative. This divergence means Lithium Americas has to work much harder to attract capital than a company riding a strong sector wave. Macroeconomic pressures, specifically the Federal Reserve's stance on interest rates, also hurt capital-intensive development companies. Higher rates mean a higher cost of financing the remaining Thacker Pass construction, which ultimately chips away at the project's net present value, and that reality quickly translates into a lower share price. To fully appreciate the tension between expectation and reality, we must briefly ground ourselves in the company's core business model. Lithium Americas post-split is a pure-play North American lithium resource development company, which distinguishes it from the newly formed Lithium Argentina, or LAAC. Its main focus is the Thacker Pass project. The business model is not currently generating revenue, it's an asset development model. It's spending capital expenditure today to build a mine and processing facility in Nevada that will, in a few years, produce lithium carbonate. They have a foundational off-take agreement with General Motors, which also holds a significant equity stake, signaling a strategic alignment that is a huge part of the long-term bullish expectation. This agreement ensures a buyer for a large chunk of their initial production, de-risking the sales side of the equation. Past performance, particularly the stock's volatility over the last few years, has been a roller coaster driven by major regulatory milestones for Thacker Pass, like the ongoing legal challenges related to the mine's approval and the previously mentioned split into two geographically distinct companies. The split was a strategic move designed to separate the operational, revenue-generating Argentinian asset, now Lithium Argentina, from the pre-production, high-growth but high-risk U.S. asset, making each a clearer value proposition for investors. This historical context of regulatory hurdles, massive capital needs, and high volatility is the baggage that the current price must carry, even as the company moves closer to production. The expectation is a smooth ramp-up. The reality is that resource extraction is never truly smooth. Looking ahead, the future outlook for Lithium Americas is a story of three potential scenarios, all framed by that core expectation versus reality dynamic. Scenario 1, the high expectation bull case. This is where the Thacker Pass construction remains on time and on budget. A significant portion of the remaining DOE loan tranches are drawn down without issue, and, critically, lithium commodity prices stabilize or slightly recover as the global battery supply chain catches up to demand, especially demand from companies like Tesla stock. In this case, the market begins to value LAC not just on its resource, but on its imminent production multiple, which would drive the stock price substantially higher. Scenario 2. The grounded reality case. Construction sees minor delays, perhaps a quarter or two, due to labor shortages, a real risk that has been flagged, or supply chain hiccups. The stock price remains range-bound, oscillating between the low 5s and the high 7s, as investors wait for more definitive de-risking of the operational startup. In this scenario, the stock trades sideways, frustrating those who bought on headlines, but rewarding those with patience, much like managing a long-term position in a Fidelity Mutual Fund's portfolio. Scenario 3. The downside risk case. This is the nightmare for the bulls. A major unexpected regulatory setback, a sustained and deep crash in lithium prices that makes even future production less profitable, or a significant capital call that dilutes shareholders. The catalysts to watch are the quarterly construction updates and any news flow about the finalization of the remaining permitting processes. For opportunities, the strategic importance of the mine to the U.S. government cannot be overstated. This is a national security-level project which adds a layer of non-commercial support that could provide a floor for the stock price. The primary risk remains the price of lithium itself, followed by execution risk at the site. This constant tug-of-war between high potential and high risk is what makes the Lithium Americas stock an incredibly difficult holding. It's an asymmetric bet where the upside is huge if all the dominoes fall correctly, but the short-term downside is equally real due to